Good morning, everybody. We're just waiting for a few more people to trickle in here. And by a few, I mean quite a few. All right. Corey, you think we're good to go?
Yes, sir. Take it
All
away.
right. Well, good morning, everybody. I know some people are still coming in, but I want to thank you all for joining us today for our Nonprofit Essentials Workshop series. So my name is Colby Cyrus. I'm a senior program manager here at the Central New York Community Foundation, and I see a lot of familiar names coming in, which is great, and I see a lot of new names, which is great too. So one of my roles here at the foundation is to develop our workshop series. So the focus of the presentation today is the non-accountant's guide to understanding the audit process and reading and understanding a financial statement. And we're happy to have Keely Hines, a partner at the Bonadeo Group, here with us to talk about this today. So before I hand it over, I just want to mention that this is the last workshop of 2025, but fear not, we're already planning a slate of presentations for 2026, and we have some really important ones coming up and some really timely topics with some great speakers. So I'm really excited for that. So please be on the lookout for those and make sure that you're on our mailing list so that you don't miss out on those. Follow us on socials, all that good stuff. And a few housekeeping notes. We are going to be recording this session and we'll be sharing out the recording with all of those who registered. We'll also be sharing the slides alongside some supplemental resources that Keely has generously provided for us. You can also submit some questions using the chat function, and or you can raise your hand virtually with Zoom. Keely's happy to answer questions throughout the presentation, so Corey and I will monitor the chat and the screen and make sure that any questions that come up do get addressed. So please don't be shy in asking anything that you're curious about. And Corey, my colleague Corey, is monitoring the chat for us as well. So if you have anything technical difficulty-wise, you can message him directly. And last but not least, after the presentation is over, you'll all be getting a link to a quick survey, and that really helps us and our speakers with feedback about what went well, any suggestions that you have, and most importantly, other topics that you would like to see us cover in future workshops. So if you could take a moment to do that in the coming days, we would greatly appreciate that. And with that, I'm going to hand it over to the expert. So Keely, feel free to take the floor. And thanks everyone for being here.
Thanks, Colby. Good morning, everyone. Again, Keely Hines. I'm a partner at the Bonadeo Group. I have been practicing in the audit space for just over 20 years, previously working for TMD that merged into the Bonadeo Group about 10, 11 years ago now. I've been practicing exclusively in the nonprofit and government space. So when I was approached with this, opportunity to speak to some folks that maybe are a little less comfortable when handed a financial statement, or when folks start, kind of speaking to that audit language and different terminology, I was really excited to try to drill down, provide some hopefully meaningful and helpful resources so that we can get everybody feeling confident with financial reporting and audit readiness. So today what we'll do is we're going to go over the process and what's involved in a financial statement audit. We're going to talk about the financial statements and reporting, so the different elements that you can expect to see when provided a financial statement. We're going to talk about the different roles and responsibilities in that audit process. So what does the board do? What does management do? What does the auditor do? And then management's expectations from the audit process. So in the event that you're going to go through an audit for the first time, what can you expect from that process? How can you feel prepared? It can be a nerve-wracking process, but at least to kind of arm you with some of those need-to-knows can make that process a little bit easier. Of course, preparing for a successful audit, and then we'll get into some practical examples. So we'll actually walk through a financial statement I'll point out some things that, as a reader of the financial statement, things that would pop out that would prompt a question, even applying some practical ratios so that you can make that data more meaningful. And then the Colby and Corey have provided some additional information and handouts that'll include a glossary of terms. So really kind of your pocket guide to navigating some of the acronyms and just some of the terminology that gets thrown around when you have an audit going on or when reading through a financial statement. And then some of those ratios that we're going to apply in our practical examples. So again, so that you've got a nice handout, one-stop shop that you can know how to calculate those ratios and what is an appropriate result so that you can truly measure the success of your financial reporting. Okay, so let's get into what is a financial statement audit and what's involved. So basically, if you go and contract or engage with an external independent auditor, the auditor is going to perform some audit planning. So they're going to establish what the scope and the objectives are of the work. And again, all rooted back at auditing to those financial statements and those transactions, and to develop those appropriate procedures and testing that should be performed, and a risk assessment is performed. So what that means is that as an auditor, when I kick off my audit, along with my engagement team, we discuss where could things go wrong? Where could an error happen and that perhaps it would go undetected? Or where could even somebody misappropriate and misrepresent the financial position of the organization? And the idea around that is so that the audit procedures that we perform can focus on where the risks are, because we can't look at everything. And that's a common misconception, and you'll kind of see that mentioned throughout the presentation today. By having an audit performed, it does not mean that everything was looked at. It would be impossible. If you think about it, look at all the number of people and the level of effort that goes into processing every single one of your transactions on a daily basis. It would be impossible for us to come in and retrace all of that without essentially duplicating your staff for us to check every single step and financial transaction that took place during the year. So that risk assessment will help us really focus on where that testing should take place. We do assess some of your controls. So essentially, we want to know that the numbers aren't just good and accurate and properly presented, but do you have a process in place? We never want to see financial reporting, being led like the wild, wild west. So how is it done? Who can post entries? Who double checks different things along the process of a financial transaction? And then, of course, the actual substantive testing is when we start saying, okay, give us the evidence, give us the information. We perform these procedures to recalculate, to reperform, maybe to observe your finance team going through certain steps, with the ultimate outcome being us providing an opinion on the financial statements. And we're going to talk about what that means a little bit more on the future slides. So what good is a financial statement audit and what does it provide? So of course, having an audit does enhance the credibility of the financial statements. So it does provide further confidence to those that may be relying on that information. In some cases, it makes maybe a donor or a grantor be able to look at your organization with a greater level of confidence, and maybe then an increased chance for willingness to collaborate or provide funding, things like that. It, of course, increases transparency. So by ensuring that the transactions are complete, recorded in the proper period, in accordance with the accounting principles. You're in essence providing more transparent and clear financial reporting. Another reason is simply to adhere to compliance. So there could be a variety of reasons why an organization would need an audit. They could include reasons set forth by the federal government, by New York State, by a grantor, perhaps a third-party lender or a third-party bank that says, sure, we'll give you this loan or we'll provide you with this funding, but we want to know that you're getting periodic audits, that somebody independent of your organization is taking a look at your operations. And then, of course, the obvious being really managing risk, right? By having an independent person take a look at your reporting, this will allow for the identification and response to risk. Okay, so what is not a financial statement audit? So a lot of folks hear that name and sometimes use it a little too broadly. So they think, okay, we've had this CPA firm come into our organization, and so I'm just going to call them an auditor. Well, we have to be careful to understand. We talked about what a financial statement audit is, but what it's not. And a lot of these services are engaged by third parties for, our firm to do or any other firms to do, but it doesn't mean you received a financial statement audit. So you may have a review performed, so it's lesser in scope than an audit, less testing, less rigorous, of course, but it also then means that that third-party independent reviewer is not looking at the same volume and maybe to the same level of detail of a full scope audit. A compilation is really kind of how it sounds. It is compiling your financial statement data into a readable document. It does not mean that someone is validating or testing those balances. They're just taking the numbers that were provided to them and assembling them in a more formalized fashion. And agreed upon procedures. So again, that sounds really how it sounds, or it is how it sounds, excuse me. It is agreeing on a very specific set of procedures that will be agreed, and we do nothing more, nothing less. So sometimes the nice results of having an agreed upon procedures is that you can really zero in on something particular. So maybe an example would be having an agreed upon procedures performed over credit card transactions. So maybe you infrequently use credit card transactions and they don't necessarily equal big dollar amounts. And as part of a financial statement audit, they wouldn't necessarily be looked at. But by engaging somebody to do an agreed upon procedures, it'll set up that we will zero in on that transaction and we will perform A, B, C, and D. Internal audit is really a service that is focused on typically a particular transaction type, maybe helping create or establish better internal controls. Again, very specific, very zeroed in on particular areas or particular transactions, and would not give you that full scope representation of a financial statement audit. An operational audit, typically, those start to take a look at truly how you operate efficiently and effectively. So we have folks in our firm, as does other firms, where we'll deploy folks out to say, okay, how are you operating? Who does what here? Does it make sense that this process flows through these 3 departments that include, these 10 people, and here's who has access and who's involved, and do we have segregation of duties? So those types of things, again, can be very meaningful and helpful for your organization, but not a financial statement audit. And then a forensic audit. So that's again how it sounds. So we have certified fraud examiners that'll actually come in and zero in on certain areas of vulnerability based upon maybe known and or suspected fraud. So again, not looking at full scope financial statement reporting, but zeroing in on where there's risk associated with fraud. And then preparation or assistance with the federal form 990, that really is a separate service and does not necessarily link or tie or correlate to the financial statement audit services. So some other things to think about in terms of what is not a financial statement audit. It is not a service performed only if there's an indication or concern for fraud. So sometimes folks think, well, why would I need an audit? I think everything is okay. And, you know, Mary's been working here for 30 years and she's always done a good job. That's not the only reason or time that you should have an audit just because there's an indication or a concern for fraud. It is not a service that's only provided to large publicly traded organizations. And on the flip side, it is not a mechanism to ensure fraud did not occur. So if you read the independent audit report, it very specifically states that the audit is not designed to detect or identify all instances of fraud. And that's because, again, we don't look at every transaction. And then certainly with fraud often comes management's override of some sort of process or some sort of gap in the internal controls. And so that's how it could still happen even if you have a financial statement audit performed. Sometimes folks think, oh, well, an audit must only care about the numbers. No, as I had mentioned earlier on, we do take a consideration for what type of control environment do you have? Do you have an active board? Is there clear communication? Is there enough people involved in the process so that maybe one person is not solely responsible or capable of doing all parts of a transaction? And then audits are not a pain, even though folks still sometimes see me come in and think, oh, great, an audit. It is not intended to be a lengthy and disruptive process. It's not intended to be a pain. And we'll talk about some ways and tips for managing that process so that you don't leave the process feeling that way. And lastly, again, as I had previously mentioned, an audit will not examine all transactions. Okay, so I did add in a few new slides since you will have received the slide deck previously. So we will share an updated version, but this was based upon some inquiries and questions that were provided in advance. So hopefully this can help provide some additional commentary. So one of the things that was asked about is really how do you respond and build a future, maybe following a less than optimal audit? So let's quick pause on what is a less than optimal audit. Maybe it is that there were findings and the auditor said, you know, hey, your internal controls are not really operating appropriately or effectively. You have a lack of segregation in duties. Maybe based upon the testing, the auditor had to propose a number of adjustments to the actual numbers so that the financials complied with the accounting principles. Or maybe an audit was not completed at all. So we're going to talk about how do you get past that? How do you get over that hurdle to start to build a future for moving forward? So how do we move forward from there? So really ensuring that you're strengthening your record keeping and documentation. So how do you do that? Ensuring that you have an appropriate accounting software. So depending upon your size and your types of organizations, there are a number of accounting softwares out on the market. It's no different than shopping for a car. If you have 10 children, you probably shouldn't get a Toyota Prius because you are never going to get your whole family somewhere. So all of that scalability and really understanding the different products available help you to ensure that you have an appropriate accounting software that reflects your organization's needs and size. Really trying to develop and determine an approach for standardized documentation. That really just helps in a number of ways, right? Your employees can know what to expect and how to process a transaction or complete a step when a standardized approach is taken. And on the flip side, it's far easier to identify if something was not done properly when you can see that something veered from that standard process. And then certainly ensuring that you have proper retention procedures. So it's really critical that you have a document retention policy and you know how to put your hands on documentation when and if you need it in the future. And then, of course, really conducting those regular reconciliations. So does your financial data represent, excuse me, all of your transactions? Does everything tie out? Do you feel comfortable with those balances? And doing that periodically and more frequently than just year end helps mitigate those risks. It's no different than reconciling your checking account. If you only did it once a year, it would be far more difficult to find an error in 12 months of transactions versus if this was a process you were doing on, say, a monthly basis. You want to ensure that you have enhanced oversight and proper internal controls. So it's really critical to have a strong and involved governing body. Everybody should really seek out having someone with some accounting knowledge and skills and expertise on the board. It's helpful to align with one or more of those individuals so that they can help speak that language, ask the right types of questions. And then you want to ensure that internal controls are adequate to allow for segregation of duties of all staff. So what that means is you do not want to have a staff with the ability to execute a transaction on their own from start to finish. So what we call it is put in segregation of duties. Who's going to come and check that transaction? Who's going to approve that transaction? Think of those types of things of eliminating one individual's ability to do everything by segregating those duties and putting proper checks and balances in. Once you've identified where you need those internal controls and those procedures and those steps, very important to have them clear, documented, and have the support retained. So you could design the most appropriate and reasonable internal control procedures and say, okay, here are these 10 things that we're going to do. But if there is no documentation to support that those 10 things happened, then how are you supposed to, one, know if it did happen in accordance with the procedures? And then how are you supposed to show an auditor that it happened? So we always like to say, but did you document it, right? That's kind of one of the sayings that if it's not documented, we don't have the ability to test it, to validate it, to observe, to reperform, because there's no information. And then you, of course, want to monitor. So as maybe your organization grows or evolves or changes in what their maybe some of their missions or programs are, it's really important to say, okay, are we following the rules and procedures that we set forth, but are they still appropriate? Do we need to modify them or improve them to adjust to the changes in our organization? Really important to always think about and address and prevent fraud. So really developing a fraud prevention policy. Really important to consider a whistleblower policy. So really something that you can provide to the employees of an organization that essentially arms an employee with the ability to come forth in some fashion to say, I don't think something seems right here. I think that this needs to be, looked into, and really kind of creating that open dialogue and creating that level of accountability. And then, of course, with that whistleblower policy, or even without a whistleblower policy, if someone comes to you with concerns, that they be addressed timely through immediate investigation and remediation. And then really fostering a culture of accountability and transparency. And that really starts at the top and trickles down. So it's upper management, governing bodies, so different, the board members or council and committees, ensuring that regular reporting and communication is happening. So if you are a board member, you're going to want to know what's going on with the organization. What can I have for some more regular financial reporting? You don't want to just see the numbers at year end. You want to see more frequent information that'll help guide your decision making, your strategic decisions, and also, again, create this level of accountability. And if you start to not receive that information and you're supposed to be, your antennas go up and say, okay, what's going on here? Let's get back on track. And then, of course, any sort of issues that are recommended, that you document that corrective action, and then again, continue to further monitor. Okay, so let's talk about what is in a financial statement. So for a nonprofit financial statement, you will have these elements included in a full financial statement. So your statement of financial position, I often tell people that they're probably more familiar with the term balance sheet. So it is at a snapshot in time at a specific date. It identifies your assets, your liabilities, and your net assets, which are the difference between the two. So your assets are your resources, everything from cash to amounts owed to you, to investments, fixed assets. So those things that are resources and available for use by the organization. And the liabilities is how it sounds. Those are the amounts that you owe to others. So it could be bills that you have not yet paid. It could be amounts owed on a long-term borrowing. It could be payroll that your employees have earned but hasn't quite yet processed and gone out the door yet. So it's capturing any sort of amounts owed and due at that specific date. And your net assets is the difference between the two. So what you have minus what you owe is that net assets number. Your statement of activities represents revenues, expenses, and the change in net assets over a period of time. So for example, the financial statement that we will take a look at will be for a 12-month period ending May 31, 2023. So your statement of activities will represent essentially a profit and loss, or an income statement is often a term that folks are more accustomed to. So your revenues are your inflows. So it could be maybe from the sale of something. It could be grant revenue or donations. It could be contributions from donors. Any sort of inflow is what represents the revenues. And then your expenses, opposite. Think of it as running your household. So that's your outflow of any sort of operational expenses, the payroll for your employees, the cost for your office space, the expenses that are associated with running and administering a particular program. It's the outflow. And then your change in net assets is the difference between the two. So if you have $100 of revenue and $80 of expenses, you have a $20 change in net assets. So your revenues exceeded your expenses by $20. And we'll talk about that a little bit more when we take a look at an example financial statement. Your financial statements, if prepared, if prepared and presented in accordance with U.S. generally accepted accounting principles, there will be a statement of functional expenses. So think about as if you were taking a look at that statement of activities that we just talked about. You're going to zero in on that expense number or numbers. And then you're going to say, I want to drill down even further. And I want to know, well, which expenses went to what programs and what, expenses related to fundraising, what expenses were just kind of our general overhead management and general type expenses. And so that statement of functional expenses allows for you to zero in on a particular program or function of your organization. So again, think of it as just drilling down into the detail of your expenses. So often when folks say, okay, so what do I do with that? And what kind of meaningful information can that provide? As you'll see in the future example, it will allow for you to say, well, how much of our expenses are really spent on our mission and our programs versus just general management, operational costs that just come with running an organization and having a business, right? Because the goal with a nonprofit should be we want to optimize and spend as much of our money on the mission. What are we trying to accomplish and what are our goals for this organization? And maybe too, you want to see how one program is performing versus another. And this is a great way to really drill down and digest the information for the expenses by a particular function. The statement of cash flows, again, how it sounds, it really is just reporting the inflows and the outflows. So it is going to take you from, in the case of a 12-month financial statement, the prior year cash balance, and it's going to walk you through to the current year cash balance. And it's going to tell you, here's what went in and out and for what type of activity. For example, it's going to accumulate, here's what went out the door in cash for payroll. Here's what came in the door for cash in the form of grants. So it's just going to give you the ins and outs, taking you from the beginning cash to the ending cash. And then the notes to the financial statement are a required part of the financial statements, and they provide additional context. It speaks to accounting policies, and it speaks to any sort of additions and deductions that may have taken place in, say, a balance like a borrowing or debt or a fixed asset. So if you go to your financial statement and you say, okay, my financial statements were, $50,000 last year and they're $100,000 this year, how do I know what changed, what happened in that 12-month period? You can take a look at the fixed asset footnote and say, oh, there are purchases that took place of X amount of dollars, and then there is depreciation expense of X amount of dollars, and that's how I get from the prior year to the current year balance. So really helpful to look at those because it provides a little bit more context as to what's going on with the financial statements. Okay, so when you have that audit performed, you will have those elements that we just talked about for the full financial statement, but at the front, you are going to have an independent auditor's report from your auditor. So some of the critical components of that report that sometimes can be anywhere between 2 and 4 pages long, and it feels like it just kind of goes on and on. I'm going to help you focus and identify on what is the most important elements. So let's talk about what you can expect to see in each of those sections of that report. you're going to hear, or excuse me, be provided an opinion on the financial statements. So if you remember, I had talked to you about the whole objective around a financial statement audit is for the independent auditor to provide you an opinion on the financial statements. That means that the auditor is going to tell you, we think these financial statements are right and properly presented or not. And then they're going to provide a paragraph that speaks to the basis for the opinion. So it's going to talk about, here's how we arrived at that opinion. We performed our audit in accordance with this set of auditing standards. We feel that the work we performed is adequate to support that opinion. So it's really just kind of going to give you some context about, here's what we did to arrive at that conclusion. Then it's going to go on to speak to responsibilities of management for the financial statements. And this is really, really important to point out, because sometimes it's easy to say, we have an auditor coming in and they're going to fix everything and they're going to help us put together the financial statement. And so that's an auditor thing. And it's really important to understand that regardless of whether the auditor helps assemble that and maybe helps you make some corrections, that your ultimate responsibility as management is to own those financial statements. Management is responsible for those financial statements. They're responsible for ensuring that transactions are properly reported. And then management is definitely responsible for ensuring that there's the right internal controls in place that can increase the likelihood that errors are detected and fixed if they happen, and that the risk of fraud is mitigated and reduced. Nothing you can do can ever eliminate those things, but it's really important to understand that the organization is responsible for putting a set of procedures in place that can reduce the risks for something to go wrong. And then it talks about the auditor's responsibility in the process. And it really is for us to determine if the financial statements are free from material misstatements. So what does that word mean? Well, if you remember, I said, we can't look at everything, right? Because we would never leave your offices and you would never get anything done and we would never work with any other clients. So we're trying to focus on, where is there material risk? Where can material misstatement happen? And so when we use that word material, it's a threshold that is determined for each of our clients, that we say, hey, if a misstatement of this dollar amount happens, we think the financial statements could be misleading. But anything below that amount, yeah, they're not going to be perfect, but we can't look at everything. We can't tie out every number. So the auditing standards tells us you only have to get to this threshold of saying, are the financial statements free of material misstatement? So again, that's really important to understand, that we're really trying to form that opinion, but also giving some wiggle room for the fact that we can't look at everything. And then of course, in providing that opinion and providing the assessment as to whether those financial statements are fairly stated, we of course issue our actual audit report. We are required to exercise professional judgment. We're going to obtain an understanding of your internal controls. We're going to evaluate any sort of accounting policies. And one of the things that we don't necessarily say here, because it's kind of in the title of the report, but we're going to maintain independence, right? Because we're supposed to be an independent third party coming in without bias, without involvement, and saying, hey, we think that this is wrong, or this needs to be corrected, or we think that this is great. And without that independence, one could argue, well, why hire a CPA firm anyway? But if we're not maintaining independence from you, then how could somebody truly trust our report and feel like, okay, I can rely on the conclusions made by this independent third party that does not work within the organization?
Keely, there's a quick question in the chat, if I could just pop in for a second.
Sure.
And you may have gone over this, I apologize, or you might be coming up to it based on this next slide. Could you explain the difference between a qualified and an unqualified opinion?
Yep. Excellent question. So, and the terminology has changed in more recent years. So when you hear the word unqualified, think about unmodified. That's the terminology that's used right now. And how I like to kind of tee it up when I go over an independent audit report with my clients is I say, if you are receiving an unmodified opinion on the financial statements, that is the highest level of assurance that we can provide. So we're going to talk about, in looking at an example of an independent auditor's report, I think that this will make sense and also guide you on where to zero in when you receive that independent auditor's report. So here's essentially an example of what one of our audit reports would look like. Ultimately, any CPA firm's audit report would look very, very similar. This is really kind of canned language and very much prescribed and tied to the audit standards. So regardless of who the firm is, you will see something that looks very, very similar to this. In more recent years, the standards dictated a move in the ordering of the independent audit report. For anybody maybe that's been in this game for a while, you might remember that a handful of years ago, the opinion paragraph was buried somewhere in the middle of the report. And at some point, the standards said, it really is the most important part. It's the piece that everybody's looking for. It needs to be at the top. So this is the paragraph that you're going to focus in on. So in this opinion paragraph, it's going to talk about the entity, right? The actual organization that in the scope of the work that's being audited. It's going to identify the financial statement elements. And you're going to see some of that language that we already talked about, right? When I went through that slide with the different elements of the financial statement, this is the auditor saying, yeah, here are the pieces of the financial statement that follow this report. And this is what we have audited. So the statement of financial position, remember that was the balance sheet, the statement of activities and functional expenses. Remember the revenues and expenses are your inflows and outflows, and then that drilled down report on your expenses. The statement of cash flows, your ins and outs of your cash, and then the related notes. So the first thing that you're going to see is, and your fiscal year end, right? So that you're going to say, okay, what stuff, what period, what entity, what was the scope of the work that the auditor took a look at? Then they're going to go into, so what is the opinion, right? That's the whole objective for the financial statement, is for the auditor to provide an opinion to the reader on the financial statements. And that that underlined, present fairly in all material respects, are the key words that you're looking for. So that represents an unmodified opinion, because what that means, right, is that we're saying, yep, this is fair, this is good, you did present in accordance with the accounting principles, and we're not modifying our position on that set of financial statements. And then we are always going to mention the accounting principles. And sometimes that kind of confuses folks, but there are different bases of accounting and presentation of financial statements. Typically, in most cases, The financial statements are going to be presented in accordance with accounting principles generally accepted in the U.S., but there is a cash basis presentation that you may see. And there's even accounting standards. There's international accounting standards. There's Canadian GAAP. So it's really important that you make sure you understand, okay, are these financial statements presented in accordance with US GAAP? And what was the opinion? Was it that the financial statements are presented fairly in all material respects? Great. That's the gold standard report that we can provide. Okay, I'm going to segue just a moment because I think it's important for nonprofits to really understand this single audit concept, because this does pop up for some nonprofits. Sometimes every year, some of my nonprofit organizations need a single audit, and sometimes it's just periodic depending upon funding. So let's talk about what this is. So a single audit is a specific special element of our audit services that is hyper-focused on your federal grants and federal spending. So the federal government has dictated that now in excess of $1 million of federal expenditures in a 12-month period will require this hyper-focused single audit to be performed. So we're going to perform our financial statement audit. You're going to get that report that I just showed you. And then if you have spent in excess of $1 million that was funded by the federal government, then the auditor is required to do some very specific testing over those dollars specifically. So a couple things, again, to remember. So if you get a special grant as a one-time deal, you may end up going over the threshold and needing a single audit, maybe only once or twice. But a large nonprofit may be required to go through this additional level of auditing on an annual basis. What's important to remember is that you do not have to receive federal dollars only from the federal government, okay? So sometimes it can be a little tricky trying to understand what are the sources of those grant dollars. And what I mean by that is there are instances that the federal government may pass funding to, say, the state, to New York State. And then New York State may disseminate those dollars to nonprofit organizations or even local governments. And those dollars would still have to be classified as federal expenditures because the ultimate source of those grant dollars are from the federal government. So sometimes folks say, oh, well, that's a state grant that came from New York State. Well, careful. You just want to make sure if you get funding from, say, New York State, that you understand, are they really state dollars only, or are these federal dollars that were merely passed through? Then when going through that single audit, like what can you expect from that, right? Because I'm telling you, okay, now your auditor is going to do a little bit more work because of this single audit requirement. So in very simple terms, it's twofold. They have to test for compliance and then the effectiveness of your internal controls. So why that is because the federal government says, we want you to spend the money in accordance with the rules. So that's the compliance piece that I'm referring to. So did you spend the money on what you were supposed to spend it on, when you were supposed to spend it? Did you follow the rules that they set forth around receiving those dollars? But they say you also need to have a proper internal control environment. So the federal government says, follow my rules, but also you better put in good internal controls in place that mitigate and reduce risk that you somehow not comply. So what they're saying is follow the rules and set up steps and procedures that make sure you follow the rules. So we have to test both of those components. So that can involve us going into grant documents, going to what we call a federal compliance supplement that provides general guidance and rules and regulations around the spending of federal dollars. And we're going to test that you spent those dollars on in accordance with the agreement. So for instance, if you received those federal dollars and it was intended for employee compensation only, and you went and purchased books, if books are not allowed, you will have committed non-compliance. So we would test for that. And if we identified that non-compliance, we would report that out. We would also say, okay, tell us about your internal controls. Tell us about how do you manage and monitor those grants? Who signs off and approves an expense? Who files the reports? Who reviews the reports? All of those types of things of what are you doing to manage the grant? And we're going to say, okay, show us that so-and-so prepared the reports and filed them on time. Show us that somebody signed off that they reviewed them. Show us that somebody approved the transaction. All of those things kind of go back to, remember when we talked about maintaining good, record keeping and having that evidence. This is a prime example of why that's so critical. And we're going to test that you have good controls in place and you can show us that those controls were in place. And then what you can expect if a single audit is done is typically somewhere in the back, you're going to find a summary of the auditor's results. And I like this report in particular. You may see it shake out in a few different formats or ways. The standards don't necessarily dictate exactly how it should look, but dictates the elements that have to be included. And I like this in particular because it is such a nice way to really button everything up on one page for an entire audit performed. So if you look here, it talks about summary of auditor's results and the financial statements. And remember how I had told you, when we perform that financial statement audit, your biggest takeaway and the thing that you want to know is, well, did they give us a clean opinion? Did the auditor give us the highest level of assurance that they can? This in one nice, easy snapshot says, yep, they gave an unmodified opinion. So that's going to be a reflection of that full report screenshot that we looked at a few slides back. It's then going to very nicely and concisely identify, did the auditor have material weaknesses? Did they have any significant deficiencies? Meaning like, hey, did they run into some problems that they needed us to be aware of? And look at this, when you see these no's checked off, this is a great way to say, wonderful. I see terminology like unmodified. I see no's, no findings reported. This is great. This is what I'm looking for. And then if you recall, as I had mentioned to you, right? So if we have a single audit, we're going to go and test the compliance. Did you follow the rules? The same type of terminology is used. You're looking for unmodified. And then you're also looking to see if there were findings in the that would be required to be reported in accordance with the federal requirements. So this is a nice, clean summary of the auditor's results that if you see this as a governing body or as management or as an interested reader of the financial statements, you would say, great, this is the report I'm looking at, and I can now rely on the financial statements and the financial reporting with a level of certainty and confidence given the results of the audit. And then if that single audit is performed, the rest of this information merely identifies what program or programs were tested, identifying if the auditee is qualified as a low risk auditee. So just again, some of the required jargon, but very high level. Focusing on this section 1 can give you a 30-second snapshot of what were the results of this audit. Again, you're only going to get this level of detail in a similar format to this if you've had a single audit performed. Okay, so let's quick talk about roles and responsibilities. So again, responsibilities of the auditor. We talked about this already, audit planning and execution, evaluating the internal controls. So really coming to management and saying, okay, let's talk about this. How do you process your transactions? What do you document? Then we, of course, love our, evidence gathering. You got to prove it. Did you document this? Show me this, show me that. And then, of course, providing that independent opinion like we have previously talked about. Responsibilities of the governing body. I know that there's specifically some board members on this call. So really, when you think about the being a member of the governing body, sometimes you kind of say, okay, I'm hearing all of this, but like I don't work in the organization. So truly, what types of ways can I enhance, and what ways should I be involved that help keep this organization on the up and up and executing the missions and the goals that I support? So one is really the governing body does have responsibility for being involved in assisting in the choosing of qualified auditors, and really kind of ensuring that, hey, is this thorough independent audit process taking place? So folks sometimes forget that, because what happens is in the execution of the audit, we have to work so closely with management because they're the ones with the information, right? They're the ones processing the transactions. They're the ones that are going to provide us the evidence that we want. But really, the governing body should be saying, yes, here's this independent party that we're engaging in contracting with, and really overseeing that audit process to say, yes, here's what I'm expecting, here's a timeline, here's how this process should go. And then, of course, really being involved in reviewing that audit plan and ensuring that the governing body is having the right conversations with the auditor, especially when it comes to the identification of risks, and then certainly just the semantics of the audit. When can we expect for this to start? When can we expect to have some reporting? When can drafts be done? When can we have a formal meeting to debrief and discuss? And then, of course, really ensuring that any sort of corrective action and improvements are taken away from that audit process and implemented and addressed, right? Because it's not helpful to receive results from the auditor and simply say, okay, well, see you again next year. It's like, well, what can I take from that process? What can we implement and what can we put in place to continue to improve our operations and continue to evolve? And then responsibilities of management, accurate financial records, effective internal controls. So again, we've talked about a few of these things. Facilitating the auditor access. So again, unfortunately, management, you probably put the bigger level of effort into the process because you're the holder of the information. You're the one that has to answer the questions, gather the documents. And then, of course, addressing any open items, issues that we may have identified. In some instances, we may come forth and say, oh, well, we've got this concern. Here's what we're seeing, or here's what we've found. And it may just mean management has to say, oh, well, here's how we addressed this. Here's this other documentation. Here was our course of action. Does this resolve the issue for you? And sometimes it's like, oh, well, yeah, we didn't know. We didn't have that information. So having the timely and regular communications between management and the auditor is really critical to moving the process along and really kind of closing the gaps between those questions and any concerns that the auditor may have. Okay, so what can you expect? So you can expect and really, kind of demand that you've got clear, timely communications, whether it be from, understanding how is the process going to work? When can I expect you on site versus remote? How will we communicate and share, financial information, confidential information safely and appropriately? How will we address questions? When can I expect an update? And then, of course, really provide actionable items for going forward, with the feedback of how did that process go, and really just kind of, saying, okay, auditor, even if it wasn't a huge deal, what can we do to make this process maybe go more smoothly next year? And that feeling is mutual too. If management is identifying, hey, auditor, I think if we do these 3 things a little bit sooner or right at the start of the audit, it can allow for these other items to follow in place and allow for a smoother process. Typical audit deliverables. So again, the audit report. So you've seen an example of that audit report, and it will summarize findings and conclusions of the audit process in a formal document. And then in certain cases, you may receive a management letter. So that may highlight different observations and recommendations for improvement from our perspective. And then, of course, when applicable and when required, you can expect compliance reporting, such as when there's a single audit required. And I like to always remind folks too, again, to try to take, the good that comes from an audit process. It's easy to say, oh gosh, this is another thing I have to manage in my day. But really trying to take something away from the process and asking your auditors, where is some improvements, even if they're not a big deal and maybe don't require formal communication, how can we strengthen our controls? How can we streamline and be more efficient, right? We're talking about nonprofits where your resources are not endless. You want to be efficient and effective with every resource you have available. And then, of course, by just having the audit, the nature of going through that process certainly enhances and increases your credibility to third parties. Okay, very, very quickly, to ensure that governance and management are ready for the audit process, engage the auditors early. Organize your financial documents, have things readily available, know how to access them quickly upon request. Assess your internal controls periodically and timely to say, is this still working for us? Is an auditor going to say, ooh, why are you doing that? Or, why do you not have a good control in place? And then assigning an audit liaison or a project lead is critical. Sometimes if there are too many people involved, but not just one person that's really, overseeing it, things start to slip through the cracks, or people assume, well, my neighbor next door is going to take care of that request and I only take care of the request if it's this type. Really identifying who is the person that's going to manage this process and this project really allows for it to be successful. So strongly encouraged. Best practices for documentation and internal controls. I'm going to speed up a little bit so that we can get to the financial statement examples. But again, having robust internal controls, you want to reduce that risk. You want to have thorough and available documentation. Keep that open communication. Look for timely updates, and really foster that teamwork to enhance the audit effectiveness. I know with some of my clients, especially for like a bigger multi-week project, having those touch points pre-scheduled allows for everybody to reconvene and just say, okay, here's where we're at. Sometimes the call or the touch point may be 5 minutes, and sometimes it may be an hour if we're really trying to sort through something. But putting those types of things in place, keep that communication and that accountability going. Okay. So Corey, now would be a great time, if you don't mind, to drop in that Green Thumb Alliance set of financial statements so we can take a look at these examples. So the following slides are all going to be snapshots and screenshots of these financial statements of Green Thumb Alliance. So because of me trying to grab screenshots and highlight and zero in, I want you folks to later have a full scale view of the full financial statement so that you can read that a little bit more easily. So Corey's going to throw that in the chat.
Keely, just before we get into that, there was another comment in the chat that said, I understand it makes sense to be with the same auditor for years since they learned the process and procedures of the organization. But how long do organizations typically stay with the same auditor? Is it prudent to be with the same auditor for years, or should they change after some time with the same auditor?
Yep. This is a common question, and certainly people have different schools of thought on this. But what I always tell people is the key takeaway is not really in the length of time that the auditor has been serving as your auditor. That is necessarily the problem. Are they still independent? Are you still getting what you need from them? And then if you feel a fresh perspective would be helpful and meaningful, we have some of our nonprofits that ask for a periodic partner rotation. We've even had folks say, you know what? We like to keep the partner locked in. We want the engagement team. So, a manager and down, we want fresh perspective from the actual audit team. So I think that there's ways in which you could respond to that. That concern about having a long-standing auditor, but feeling like you're having a fresh perspective, but not starting over again. And then, really, again, just having that open dialogue with the auditor. If you're getting what you need and they're maintaining their independence and they're doing what they are supposed to be doing based upon the standards, which is to make some modifications to our approach in testing each year, it should prevent you from getting kind of that stale sense of like, all right, they're coming in and doing the exact same thing each time, and now my management is going to know exactly how to get away with something. We're required to implement on a level of unpredictability, modify our approach to what we sample, what we may look at. So those types of things can provide variety and change in your audit process without overhauling and necessarily engaging with a new firm. Okay, so let's take a look at this example. So again, this is Green Thumb Alliance. So this is the statement of financial position. So if you remember, this is the balance sheet that we talked about. So you can see I've got my assets and my liabilities and my net assets. So this is providing me what is the position of the organization at May 31. Some notable items on here that if you were to just say, okay, somebody hands me this financial statement, what types of things would pop out that would kind of prompt discussion, maybe questions, the desire to maybe know a little bit more, from a board member perspective, maybe this would prompt some inquiry of management. So current assets, increased. So your current assets increased a couple $100,000. Your long-term assets, you don't have any. So that is great. Or excuse me, long-term assets are your non-liquid. You have no long-term liabilities. Excuse me. Let me rephrase that. So long-term assets are your non-liquid assets. So that's your investments or your property and equipment. So meaning it's not cash and readily available or converted to cash. And then you have no long-term liabilities. So meaning no long-term debt, maybe a mortgage, a long-term borrowing. You really just have current obligations. Right here it says net assets without donor restrictions. That's some key terminology right there in terms of what that tells you is of all of your assets minus all of your liabilities, you have no restrictions on what is left over, okay? Because what could happen is a donor could provide you with some resources, but they could tie your hands with regards to how you have to use that. And so that can impact your ability to spend or make changes or really make those resources available. So this story tells me you have net assets without donor restrictions. Okay, whatever you have in assets minus your liabilities is available for use. And your net assets are remaining relatively flat year over year. Okay, so possible questions and maybe items to consider. So you will see your investments decreased with tick mark A. Your investments decreased about 5% from the prior year. So what could that mean? Does it mean some of the investments were liquidated? Does it mean that there was a loss on the investments? You know, really just wanting to understand, hey, what's going on with that? Considering that there was a 5% decrease from the prior year. Looking at tick mark B, your AR increased nearly $75,000. They're up about 50%. So what is accounts receivable? Accounts receivable are amounts owed to the organization. So if I were taking a look at this financial statement, I would want to say, what's going on? Are we not collecting from these third parties that owe us something? Maybe there's a story to be had. Maybe a collector or an AR clerk position is open and the work is being kind of spread out over a few people. And so yes, collections are slower, but it could be a real indication that, all right, well, maybe we do need to get, said position filled and quickly, because this is actually negatively impacting our cash flows. It also could be an indication that, well, historically we've been able to get these receipts on our grants within 60 days. It's now taking 120 days. New York State is moving slower, yada yada yada. So it could be things are outside of your control, but would be certainly things you would want to understand. Letter C is around your PP&E. So those are your fixed assets. So they increased about $20,000. So that would tell me that I would be expecting to see some additions. And then, are there additions offset with disposals? What's the depreciation? Again, to just really understand what is going on. I'm seeing changes that are happening. And then letter D, the accrued wages and vacation payable. So this is a nice snapshot too, to just say, well, what's going on with accrued payroll? That represents payroll that your employees have earned, but you haven't given them yet, right? Because at year end, whether it be May 31 or December 31, you don't run a special payroll to say, okay, we're closing up our year end and we're going to pay all of our employees and do a special, paycheck just to make sure we pay them before year end. No, you're going to follow your pay date calendar that's been set forth. And so what happens is, to properly capture the payroll in the right period, you may have an amount that is owed at May 31. And it's nice to say, okay, does that number make sense? You know, it increased about 17%. It could be the number of days and the way that the calendar falls for the payroll cutoff and when you'll actually pay the employees. Could also be increasing because of increases in wages. But it's really kind of one of those things where I would say, okay, tell me what's going on here. You know, is this number appropriate and reasonable? Let's take a look at a ratio. So the current ratio is an indication of the current assets over the current liabilities. So it's really an indication of, can you meet your current liabilities due using only your current assets? And the answer is yes. So really for a nonprofit, anything around 1.5 to 2 is considered healthy. In this particular example, Green Thumb has exceeded that. So what that means is that they have plenty of liquid available assets to pay any of their bills and amounts due to third parties. So this indicates financial health and your ability to meet those obligations. Liquidity, again, in a similar fashion. This is really the same ratio, but very much zeroing in on exactly the cash that you have currently. So if you remember, we were taking current assets, so it could include amounts owed to you as well. And so, of course, until you get that cash, it's not necessarily available to pay to somebody else. So this really zeroes in on, okay, what do you have in your bank account at this moment in time to pay those current liabilities? And again, anything in excess of 1 is considered healthy. So again, Green Thumb really has the ability to meet their obligations simply using the cash that they have on hand at May 31. Debt ratio, so really looking at the total liabilities over the total assets. So you want to have less debt in terms of really saying, okay, what liabilities do I have on hand in relation to the total assets? And really well below, the organization has well below 50% of their assets financed by debt obligations. So that is what you're looking for, is that your cash is not based upon a borrowing. So if you go take cash and draw it down on a line of credit, you technically still owe that to somebody, right? So that's what this is taking into account, is really what obligations do you have over those total assets. Okay, let's take a look at the statement of activities. So again, reminder that this is your profit and loss or your income statement. So it is showing you your revenues and your expenses over the period of the 12 months ending May 31, 2023. Okay, so taking a look at the formula that I've put at the top. So A minus B plus or minus C equals D. So what that means is your revenues minus your expenses. And then if you have some non-operating, it depends on what it is, right? As to whether it's an inflow or an outflow. So that's why I say plus or minus, equals D, your change in net assets. So let's take a look at notable items when if I were handed this financial statement. One of the things to note is that your operating revenues are less than your operating expenses. So you see right here, we put a whoops, I apologize, I advanced a screen. Here we go. You will see that we end up with a negative change in net assets from operations. So that is okay. However, really important for you to understand that without these non-operating activities, you had a net loss, okay? So that's important to understand that at this point in time, you are reliant upon some return on the investments. And if they don't do well, you could be looking at increasing a loss. So in this particular case, that's what happened, is that there was an unrealized loss on the investments. So those non-operating activities didn't help. We already started with a loss. And so we ultimately are depleting some of the net assets. So not to a point where there's any danger per se, right? We talked about all of our previous ratios, but when I look at this, I would say, as a reader of the financial statements, okay, is there a reason that this was a one-off? We wouldn't want to make a habit of this because eventually you would deplete all of your resources. Are there changes that we need to make? Do we anticipate improvements in the market with regards to our investments? This will allow for you to ask the right questions, especially when thinking about preparing your budget for going forward. So what are some things to understand and maybe to ask? Again, as I just mentioned, really consider the changes between the prior year and the current year. So why are the results what they are? Why did we experience a loss? And then considering, is that what we budgeted for? Sometimes there might be a reason that you budgeted for a small loss in a particular year. There may have been a particular investment that was made. What if a new accounting software was put into place? Or what if a new program was launched and it took some upfront costs that we don't anticipate in the future? So again, a loss does not necessarily mean a crisis. It means it should be explained and it should be considered in relation to what was budgeted and then in the development of future budgets. And then if you remember, we talked about that change in the investment balance on the statement of net position or financial position, and that reduction that I had said, hey, that would have popped out at me. I would have just wanted to know what was going on with the investments. It's absolutely being driven by that net unrealized loss on the investments. So by kind of then taking a look at the other side and looking at the revenues and the expenses, the inflows and outflows, you can say, okay, I understand now how the investment balance did reduce. And then I think it's really important to identify the fact that this statement in particular has two columns. One column doesn't have anything in it. So if you remember, I had talked about how there were no donor restrictions in your net assets. And that's based upon the fact that there's no activity with donor restrictions. And that's really important to understand because, for one, like I had said, that means those resources are available. But does it make sense? Is it consistent with expectations? Do you typically have resources that you're receiving with donor restrictions? Did you expect that? What you don't want to do is classify something without donor restrictions if in fact there are restrictions. And then one thing that I wanted to note on here is that yes, this presentation is an acceptable presentation in accordance with accounting principles, but I think that it's helpful and meaningful to insert an additional column here to just show your totals for the prior year. It's nice to be able to look at this schedule and have that comparative information. So that's always something too that management, the board can say to the auditor, hey, when we start pulling this stuff together, I would love a comparative prior year column. It's nice to see everything in one place. Okay, so let's talk about some ratios that you would be able to apply to your statement of activities. So again, what's going on with your revenues and your expenses in particular. So this program efficiency ratio is, really kind of nice because it zeroes in on the program expenses in relation to the total expenses. So you might remember from earlier in the presentation, we talked about the fact that a nonprofit is operating with a mission to execute serving the public, serving some sort of cause. So ideally, you want to see as much of the expenses going to programs versus, say, management in general. So one of the ratios that can help kind of tell a story with regards to how much are you spending on the program versus other expenses is this program efficiency ratio. So in this case, just over 75% of the expenses are related to program service expenses versus the management in general. So that can give you a sense for, great, we're not just pouring money into overhead and the fact that we're operating a business, we're actually executing a mission through the facilitation of our programs. On the flip side, I always like people to remind people that, you know, they could say, well, I want to get this number higher. I want to get this percentage higher. At some point, there could be a tipping point where that number could be too high and that you may not have the right infrastructure and resources in the background for individuals that are running the organization versus specifically facilitating the programs. And that could lead to different problems. So it's really nice to kind of determine and build up the historical context for your organization of, do you run at about 75%? And if you start seeing significant fluxes, is it because maybe you've eliminated some programs and now your management in general proportion is sky high? And maybe you need to shrink down some of those management in general related expenses. But on the flip side, if you are launching new programs and pouring all of these resources into the program related expenses, do you have enough people in the background helping to support that? And that's really kind of establishing what that delicate balance is really something that's important. And again, looking at that historical data to know what works for your organization. Operating reserve ratio. So this is taking a look at what do you have for unrestricted net assets. So again, those net assets that are available, and what can then be applied to the total operating expenses. So what they're saying is that if you were to generate not a single additional dollar of revenue, how long can you sustain? In this particular case, this organization can last almost 2 years just using the net assets to support expenses of 3.2 million. So if you maintained a consistent budget, give or take, you would be able to exist for 2 years without, or just a little less than 2 years without generating another dollar of revenue. So again, this ratio is based upon a recommendation of like, yes, you should be trying to exceed that 3 to 6 months. On the flip side, there could be criticism at some point that could say, you're a nonprofit. How are you not using these net assets? So again, exercising caution that it's not a complete free-for-all and that the higher the number is, the better, and it means you're winning. No, it really means that it could be an indication that you're not spending enough and putting enough into the facilitation of the program. So again, building up this historical data, doing these ratios so that you can understand the story is really how you can best run your organization. And then this one is kind of nice too. This is a contributions ratio. So it's looking at how much of your funding is reliant on contributions. In this case of this organization, it's very little. The risk that can be involved is that if economically and socially things are changing and maybe ad hoc contributions and donations drop at a given point, if you are really reliant on those dollars, that could significantly derail your ability to meet your obligations. So really, this is kind of just pointing out how much of your revenues are coming in through contributions. Do you have a heavy reliance on it? And not that that is a problem, but would you need to be able to pivot quickly if those resources and contributions were to decrease? Okay, moving on to the statement of functional expenses. So again, remember that this is the representation of the total expenses broken out by program. So on your statement of activities, you had just these totals. So you saw the 1.109, the 586, the 765. And this then allows for you to say, okay, but what does that make up in running that program? How much is salaries? How much is staff training? How much is supplies? So that you can really see what does it take to run that particular program. So this essentially is a screenshot that represents a view of that statement of activities and shows how it agrees to your statement of functional expenses, but provides you further detail. So again, really helpful for understanding how each of your programs runs, how much, what are the percentages, comparing the efficiency and effectiveness of the programs. This can be a really meaningful statement when trying to make some decisions about future programming. So some possible questions or items to consider. So really calculating the percentage of expense by function and comparing it to prior year. Calculate percentage of program versus management in general. So is there, if you're in a position where you do need to make cuts, where is there a program that perhaps is very expensive to administer? And do you need to eliminate it or at least modify it in some way to make an immediate impactful change for the good? So again, really drilling down and looking at things by program can help with some decision making. And then of course, looking at your budget versus actual. Is this in line with what you expected? Let's take a look at the administrative expense ratio. So again, this is going to be the flip side of the program expense ratio, right? This is the other half of the 100% or the other portion of the 100%. So this is taking a look at, you have management in general expenses that don't particularly pertain to a program, and how much of your expenses are those types of expenses. In this case, 23.5 is a little high compared to what the ideal ratio is. But again, you have to consider if this is what is needed to run the organization, or in some cases, it might mean that something's not classified properly. Regardless, especially if looking at historical data, if there was no real change or explanation, but you see this percentage creeping up from prior years, is it that we're not properly classifying or identifying expenses that do really pertain to a program? Because we certainly don't feel that we can cut anything or reduce any headcount. So again, really staying informed and understanding your numbers can help guide those discussions and decision making for going forward. Okay, statement of cash flows. So if you remember, this is going to give you your additions and deductions. So it is going to take you from the beginning of the fiscal year to the end of the fiscal year, and it's going to break out the cash flows by operating and investing and financing when applicable. A good example of financing would be if there was a borrowing taking place. So a very quick snapshot of this. Here is your beginning cash balance, which matches your prior year cash balance. And here is my ending cash balance. This schedule is how the ins and the outs took place for the entire fiscal year. So the changes that took place within each of these balance sheet accounts is what was driving a movement in cash as you worked your way from 6/1/2022 to 5/31/2023. Again, pointing out a couple things that tie you back to the financial statements, as I had mentioned, for the tick marks A and B. So those balances tie back to your statement of financial position or your balance sheet. And then you will see your change in net assets of your revenues and expenses tie back to the statement of activities. So again, typically, even as a presenter or as a user of the financial statements, I think you would probably use this schedule the least. You're not necessarily going to use this for making decisions, evaluating your operational effectiveness. Really, those previous slides and schedules is what's going to arm you with the necessary information to ask the right questions and lead the organization to continued success. With that, I will check in to see if there's any final questions or thoughts. As I had mentioned before, you will get if you have not looked at the documents yet, you will get a full listing of the ratios that we went through today so that you've got a pocket guide for that. A nice glossary of terms that can get you all talking like a bunch of accountants, and you will get an updated slide deck for your future reference to incorporate some of those new slides that I inserted based upon early submitted questions.
Well, Keely, thank you so much. Does anyone have any questions while we have a few minutes? All right. Keely, I have one question because that's how I am.
Sure.
This is obviously a time for our sector, the charitable sector, of intense scrutiny and a lot of anxiety. So I'm curious, from your perspective, how can effective record keeping help nonprofits protect themselves from inquiries, investigations, all that stuff that they might be dealing with?
Yeah, and that's a great question, Colby, and you kind of nailed the answer right in there. And I mean, it really is that adequate and complete documentation. And these really are kind of the days where more is more. So not less, and you really need to document decision making and lay out expectations for what documentation will be needed as a bare minimum to be considered complete and adequate. So that's really where it comes into place in terms of standardizing, developing and documenting what your procedures are, so that then every single employee or person involved in the process understands what to expect, what checks and balances should take place, what will be documented, where will it be documented, how will we retain it, and how will we retrieve it if we need it. And those are really the critical components, so that not only does your existing workforce understand, but when there's turnover, the goal is to try to make that as seamless as possible. And if you have documented procedures and expectations and standardization, the sooner that you can then get a new person up and available, or even allow for a seamless transition for a temp to come in. Those types of things, again, that the more standardization and documentation retention that you can do, the better. So that you can go to a grantor, an auditor, an interested third party, and be able to answer those questions with confidence and know that you followed your procedures.
Awesome. Thank you so much. There are some questions in the chat that are rolling in. So let's see. The first one was if you could address internal audits and kind of give an overview of what that means.
Yeah, so they come in a lot of different shapes and sizes. So there are some industries that are required to have a rather prescribed internal audit. For instance, some financial institutions, right, which would not be this audience, but they're required to have internal audits done because of different SOC compliance requirements, things like that. There are instances where school districts are required to have internal audits, and it's in light of 20 years ago, some really significant fraud and issues that took place in now legislation in New York State mandating that New York State school districts have this internal audit function. So again, it's to drill down and focus on a particular area or transaction class, a particular department. So in your cases, as a nonprofit organization, it could be the means for, again, drilling down on into something specific that maybe wouldn't necessarily be picked up in the higher level of scope of a financial statement audit. Because if you remember, the financial statement audit can't touch everything. It can't look at every single transaction. It's going to consider those types of numbers and values that are tied to a materiality threshold. This internal audit can be the means for somebody coming in and doing some focused testing. And even so far as a larger organization may have what they call an internal auditor, where it's an in-house person that may go and review claims and expenses over a certain dollar amount, or double check that the documentation is complete and adhering to the internal controls. So it comes in a number of different shapes and sizes, but what's important to note is it will not fulfill the requirement of a financial statement audit by scope and nature, but it won't for those instances where a financial statement audit is required. They're very different. The objective is very different. So it's important to understand that if you have one, that you know, okay, that is not a financial statement audit.
Great. Thank you. That's a great distinction and great question. So thank you for that one. And the last question, Keely, that I see is what kind of processes do you recommend to help with financial oversight for nonprofits that have one full-time employee?
Yeah, and that it's hard, right? Because you heard me saying, okay, I'm supposed to put these segregation of duties in place, but if we're small by nature, or we've shrunk down our workforce, and I don't have any other options, it's really critical for the governing board to play a role in oversight. So that's one mechanism for implementing a layer of checks and balances. And it may be that somebody on the board is responsible for actually looking at the bank statements and the bank reconciliations every month. Maybe a board member is serving as a check signer. And then other ways too is perhaps leveraging the help from a third party on a periodic basis. The problem with that is that that likely is going to come at a cost, but it is a feasible option to bring in a third party and say, okay, how can we incorporate this independent third party into our internal control environment that maybe 4 hours a month they execute these 6 items as part of a checks and balances. So you certainly have to get more creative with a smaller workforce. And certainly if you're down to just one person, you really need to have board involvement. And if it's one kind of business office or finance office individual, see what sort of help you can leverage from an executive director. What sort of layers and checks and balances can you put even to just leverage other individuals within the organization? But the key takeaway is making sure too, though, that whatever and whomever you involve in these additional checks and balances, that they have the necessary skills and competency to do so. It would, not necessarily be appropriate to ask that an elementary school English teacher assemble a financial statement and kind of oversee that process, because they probably don't have the right skills and expertise. So it really goes back to kind of arming your board with the right people as well, and making sure that, if you don't feel that you have that and you don't have somebody that can help, you probably need to take a look at the composition of your governing body.
Absolutely. And we do see, of course, so many nonprofits and groups that do have only 1 or 2 full-time employees, and in a lot of cases, no full-time employees, right? So the governing body becomes that much more important. All right, ladies and gentlemen, any other questions for Keely? You're free to come off mute or throw it in the chat. We have a few more minutes, so if there's anything you're curious about, don't hesitate to ask. All right, I don't see much else. So Keely, thank you so much for taking the time out of your morning to help walk us through this. I know it's a really, really important topic, so we really appreciate your contributions. And everybody,
My
thank you for your
pleasure.
participation. And don't forget, those surveys are going to be coming along in the next couple of days. So please submit your responses to that and help us keep thinking through our programming. So I thank everybody for coming, and enjoy the rest of your week.
Thank you. Take care.
All right, bye-bye.